Hi, this is Professor Hazara, and this is the second video on note foreseeable. It's going to be incredibly short because it's an important concept, an important video, but it's all built on the last sheet I just made. Okay, now if you recall, on the last sheet, I said there's basically notes receivable are issued under two circumstances. One, when you just give a loan, it's a plain loan, that there's no good exchange or anything else. The other one is that you can finance this sale. When you sell a good, somebody may want to finance it through a note receivable. And it can be a complicated thing, some of these, but I'm just going to show you one basic aspect of this that is very important. Okay, and what I'm going to do is, you've already seen, and I should probably have already posted this worksheet that I built in the last video here, where there was just a loan on a note receivable with a face value of 100,000, 3-year term, 5% nominal rate, 7%. The amount of the loan, it was a discount loan, and the face value was 100,000, but the company, because of its 7% credit rating, was only loaned 94,751. And then we made the amortization table, which worked up in this case, and then we made the journal entries. Okay. And now what I'm going to do is I just want to emphasize one aspect of that occurs when a note is issued, not just as a loan, but when it's issued as when you're selling a good. Now, in this case, I'm just going to go over to this sheet over here, which you'll see. And the scenario two is no receivable for the sale of an asset. Now, I'm assuming here that this is a sale of inventory. By that I mean I think they're selling a truck. So this is a truck dealer, which would be different than if you were just selling a piece of equipment that had been used in your manufacturing business, but you were not in the business of selling a piece of equipment. So because I'm selling something in my inventory, that's revenue that's going to come in. Okay, so the example is exactly the same. However, in this case, rather than being a loan, I just put here the ABC company sells the Y company a truck. Truck has a fair market value sales price of 94751.97 and a manufactured and a cost of manufacture of 85,000. Now, when you sell something and you finance through a note, there's going to be two sources of revenue. One is the sales price of the truck. You're selling something in your inventory, and that's revenue. And this is your cost of goods sold is 85,000. So that you're going to have a gross profit of 8,000 something, or 9,751, something like that. But anyway, in this case, you have two sources of revenue. One is going to be the revenue from the sale of the truck. The other one is going to be the revenue from the note itself, the interest revenue. Okay? And the way this is usually handled, it's usually pretty much assumed that the present value, we calculated the present value over here, calculated the present value of the note right here, and all this is exactly the same except for one or two things. There's the same calculations, the present value of the note. We generally assume in such cases where you're selling a truck and you're going to get paid for it in the future by issuing a 3-year note with 5%, 100,000, you'll get paid in 3 years, and the $35,000 payments. We usually assume that the present value of the note represents the sales value of the truck. Now, why is that? It's because you would presume, and this is supposed to be an arm's length transaction, you would presume that the value that you're getting now for something monetarily is what it's worth. Okay, so we're saying, okay, you get all these payments in the future. That includes a bunch of interest revenue. However, the present value of all those should equal what you think the truck is worth today. That's why there's just going to be one or two journal entry changes here, but that's an important point. Okay, so I want to emphasize here. So we've got this usual thing here, the same circumstances, the following steps. Okay, so we've got the same price. So I haven't changed that just to keep it simple. But I want you to keep an eye on this number right here. that number right there. Okay. And we come over here. The value is the same. The amortization table is the same. However, the first journal entry is going to be different. Okay, the first journal entry is going to be, you'll notice that I've got those journal entries there, and you'll notice the similarities. The first journal entry in this case is you are selling a good, a truck in this case, which is what you manufacture. How you make your revenue, you're selling it. And in essence, you're selling it for $94,751. So these two numbers will generally, not always, but generally, the theory is that these two numbers, that number and that number, are equal because you're going to get all these payments in the future. The value of those payments today is $94,751, and you're willing to trade that truck for a note with a value today of $94,751. Now, the rest of those payments, the $5,000 payments, are actually the second source of revenue, which is interest revenue. Okay, so here is the way this is going to be recorded. Very similar to last time. You're going to debit note receivable for $100,000, which is the face value. You've got the discount on the note for 70, 52, 48, 63, same as last time. But you're going to credit sales revenue for 94,751. Okay, and then we come down here. Don't forget, you're going to have your cost of goods sold in this case is 85,000, and you're going to have to write down your inventory. This is using a perpetual inventory system. So this goes on your income statement, the sales less your cost of goods sold. That's going to be your gross profit, and then you write down your inventory. After you do that, you're more or less the same situation we had last time. It's you have $100,000 note receivable, a discount, which appear here, and once those appear there, you just start recording interest entries exactly as you did last time. So the main point in all this is that when you sell something for a note, the present value of the note really is what you're exchanging today for whatever you're selling. So that would be the arm's length purchase transaction. And then, of course, that's going to be reflected in your, if the truck is inventory, it's going to be reflected in your first entry as sales revenue because you're willing to exchange that truck for a note which today has a value of $94,071, exclusive of future interest payments. And notice that, of course, you have your future interest revenue. Always interest revenue that's recorded note. That's the main point of this, is keep that concept in mind. Now, it could also be, and the book has an example, where the truck is not part of inventory. It's like a pharmaceutical company selling some lab equipment. Well, they're not in the business of selling lab equipment. They're in the business of selling drugs. So if they sell some pharmaceuticals, that would be revenue. But if they have a building they want to sell or something like that, then you would probably record a gain or loss on the sale, and that's a slightly different situation. The same kind of concept comes in here. You ask yourself, how much is the financial instrument you're trading today worth? And are you willing to accept that for what you're selling or giving up? That's the concept. Okay, let me put this video up, and it was short. We'll stop right there.